Can people hear all right in the back or not? At the very back, people can hear? Not so well. Maybe we need a little more volume, but anyway. Raise your hands if it gets bad. I think they need a little bit more volume. Thank you very much. It's great to be back to Vienna. It's a challenging time. It's very rare in the history of science that difficult, counterintuitive, complicated problems have easy answers. We'd like to think it's all easy. For example, consider the use of the phrase fear and greed to explain what happens in markets. The problem with the phrase is it means everything and therefore nothing. It has no meaning. The history of science is about the substitution of predecessor theories, alpha, that are fuzzy-wuzzy and bad, with better theories that work better, predict better, but most importantly, explain better. That's the history of science. Economics and the analysis of markets is part of this. Once upon a time, we did not know what a supply and demand curve was. We couldn't really define the concept of market equilibrium. We've just heard an interesting discussion of how rapidly equilibrium prices can change. Oil goes way the hell up, much further than seems on the surface sensible, and then way, way down, proving that the previous price was a bubble. Now, this to me is a statement that is not right or wrong, but has no meaning at all, as will become clear later. That's all right. The important point was that in the subject of what was used to be called natural sciences, we all believed strenuously in the equivalent concept of greed and fear, but it was called the phlogiston. The phlogiston was the force that caused fire and fed fire. But then we discovered oxygen. And the phlogiston was never again heard of. We didn't need it. It was replaced by something that worked better. Oxygen explained better and predicted better. Okay. This is true of all science. First, once upon a time, we assumed that the sun went around the earth. Aristotle believed that. He was wrong. We learned later that the earth goes around the sun. Correct? It changed everything. But that is also wrong. We learned later from Sachs and Einstein that there will always be a geodesic in curved space-time from whose perspective both the sun goes around the earth and the earth goes around the sun. You will not understand that unless you are toilet trained in how to think first. It is counterintuitive. It is not easy. I know nothing where solving serious problems has ever been easy. I want to talk today about a very complicated problem, the global financial market meltdown. I want to try to explain it from first principles, why this could have happened. The Queen of England asked last Tuesday at the London School of Economics, why didn't anyone see this coming? I think she spoke for almost everybody. The problem is, what is the this that no one saw coming? It's a complex this. And I want to dissect it in pieces, and using extremely powerful new work from Stanford University in the foundations of mathematical economics, and no, I'm not going to use any math, it is now possible to explain all of these things from first principles with no psychobabble. No assumption of irrationality of any kind is needed to explain anything that happened. No concept of fear and greed is needed to explain it, although that is usually what you hear people talk about. This is deep stuff. It works better, and it satisfies the philosophy of science requirement that a new, better theory must subsume as a limiting special case previous theories. That is, at a mathematical level, the 10 equations of gravity of Einstein do not reject the previous concept of Newton. Rather, in the appropriate special cases where Newton works, the coefficients of 9 of the 10 equations go to 0. You do not need them, but you are left with the Newton potential function, and that's all you need in that narrow area. We can now do the same about explaining oil prices and market overshoot. There are times when it is absolutely true that what people used to call, quote, psychological factors are at play in causing what people used to call a bubble. but there are other cases when you need nothing but a fundamental analysis at all. The problem is you need a better understanding of the meaning of fundamental analysis than we typically are offered. So I hope you will view this as an effort to try to clarify the greatest single development in modern financial market history using extremely advanced new logic, all of which can be mathematized and none of which requires concepts like fear and greed. This is a major achievement, but it is typical of what's going on in all sciences for 1,000 years. Your Majesty, what is it that you're saying no one predicted? Was it the subprime crisis? That was pretty bizarre. Was it the staggering scope and speed with which the balance sheets of major money center banks deteriorated? It was $15 billion Monday morning to bail out AIG in the same week when it was $86 billion 3 days later. That's pretty bizarre, isn't it? 142 billion of liquidity on the balance sheets of Goldman and Morgan Stanley, and 4 days later they must forced to be filed as commercial banks, cutting the payouts to partners of at least 70% because they too were going broke. Citicorp, in a matter of 3 or 4 days, goes from, quote, adequate to a basket case, which is now partly owned by the U.S. government. Your Majesty, very strange things are happening indeed. They get even stranger. Main Street is never brought down by Wall Street. Stock market crashes, even in the emerging markets, have very little impact on Main Street. Main Street is what matters. Main Street is where, if things are good, you don't have broken glass and revolutions. But if you don't have good things on Main Street, you elect Hitler. Stock markets have very low equity wealth multipliers. They really don't matter. They matter to you and me because we're in the business. But they don't affect GDP, as the New York Fed has shown with serious econometric work. Usually, of course, things are the other way around. Main Street brings down Wall Street. If there's problems on Main Street and you're all fired and no one has a job, you better believe the stock market is finished. Main Street brings down Wall Street. If there's problems on Main Street and you're all fired and no one has a job, you better believe the stock market is finished. Main Street drives Wall Street, but Wall Street does not drive Main Street. And there's very good reasons for that in an age of a very high marginal propensity to consume out of income and extremely stable income that never goes negative. This time, Wall Street seems to have brought down Main Street, Your Majesty, another strange aspect of what is happening. But stock markets were not the Wall Street that brought down Main Street. The credit market is what brought down Main Street. And that has never happened. But what do I mean by the credit market? I haven't lost money in the credit market in the United States. 2/3 of my bonds are governments, 1/3 are corporate. My corporates went down, my governments went up. We've had no crash in the bond market the way we have in the stock market. So how has Wall Street brought down Main Street? What is going on? This time it was not the price of credit, it was the non-availability of credit. This is a very different point. All of a sudden, no one could get a loan. Not only in New York, but in Buenos Aires and in Australia and in Iceland. Nobody could get a loan starting in September of this past year. This is what brought down the main streets of the world and what could be the worst global depression, or recession, I should say, in 5 decades. No one knows yet, but it's pretty serious. Your Majesty, it is astonishing that world GDP growth was 4% 2 quarters ago, and it is now 1, estimated 4th quarter. Never has anything like this happened, Your Majesty. It's quite extraordinary. So, Your Majesty, the reason why nobody really predicted this very well is none of this has happened. Saying that there are always bubbles Yes, there are bubbles. There is excess optimism and excess pessimism. Regrettably, the fluctuations do not form a knowable, arbitrageable cosine function, but rather have random patterns which are non-arbitrageable and show little statistical regularity. But certainly excess optimism about returns and excess pessimism about returns cause financial markets to go through cycles of booms or busts. Everybody knows that, except the Chicago School of Economics, where the concept of excess optimism or pessimism cannot exist because of the mathematical assumption of the stationarity of the stochastic process generating the news, leading 4 pages of mathematics later to everybody possessing the correct conditional probability of everything forever, meaning there can be no such thing as optimism or pessimism. But that's a small footnote, which had it been understood 30 years ago would have prevented what happened today, because all the models based upon such lousy logic, as we now all know, have backfired and collapsed. There's nothing like bad theory to really screw things up. If you use a bad theory of physics and send your wife to the moon and back for her anniversary, you won't see her again. It's no different in our business. And we have a lot of really bad theory, as you're about to see, that helped cause the problems that are hurting so many people today that did not get 50 million year bonuses on the way to stowaway. On May the 7th of 1937, the great dirigible from Germany, the Hindenburg, landed in Lakehurst, New Jersey. 50 meters above the ground, a small fire broke out, and to the shock of everybody watching, the fire engulfed the entire dirigible, breathlessly. It's the Hindenburg effect, which we now want to explain, Your Majesty. How could it all go so wrong so fast? And how could credit market distress and subprime close down the main streets of the earth? And that's what's serious. What's serious is when unemployment goes from 6 to 15. That's when we all elect Hitler. It's not funny. So here we go. A diagram will help. I'm going to give you a shallow analysis first. Then I will rigorize it by analyzing 3 games second using advanced game theory, but using it intuitively with no mathematics. I want to discuss pre versus post-relativity economics using the new work on endogenous risk from Stanford University, developed in the past 10 years by Mordecai Kurtz and other people. Kurtz holds the chair formerly held by Kenneth Arrow, who invented modern finance, the youngest Nobel in history in any field, and my PhD advisor. This graph is very important. The question is, what would give us the perfect storm? I published this 4 years ago. And then a year ago in January, 9 months ago. Below the dotted line, I filled out for this. But the question was, what would give us what's happened today? That's all I was interested in. It hadn't happened. I was interested using the new work in Stanford. What could give us the perfect storm with this crazy Heisenberg effect shocking everybody? And how could one predict this or explain this without using psychobabble about people being irrational and following trends for no reason, etc.? They do follow trends. As we're going to see, trends are very important. But the economics literature, until the work at Stanford, assumed the trend-following behavior was for morons, because trend-following behavior violated the random walk assumptions of efficient market theory. As has been true in the history of science for 200 years, but spectacularly in the last 60 years, a very important thing is to realize that very often what looks irrational is not. But by a more clear understanding of the meaning of rational, the behavior that looked irrational was not. Before beginning, because I'm going to use it later on, the most important advance along those lines in the history of thought was the discovery in 1952 by the distinguished Princeton mathematician Albert Tucker of the prisoner's dilemma game. The prisoner's dilemma game, I think, is probably known to most of you in one way or another. It has revolutionized the theory of evolution, sociology, political science, and economics. It is a game in which what's good for you and what's good for me is jointly bad for both of us together. It is the divergence between individual rationality and collective rationality that is the hallmark of many social phenomena. We will be using this shortly. Repeat, one bimatrix game changed how we think about 4 disciplines. That's interesting. And that's what you're also about to see. Okay. I want to show how you can get a perfect storm by making you understand why you cannot get it in any standard pre-Stanford economics. And nowhere here do we use the concept that people are irrational. I've never met an irrational person. Rational has to do with whether or not when you pick a portfolio or decide to continue as you did with your trend, the reason is because he thinks it's going to make him money. I don't care why he thinks that. That's another matter. If you act in a manner consistent with your beliefs, you're being rational. That's all the word ever meant. The most important mathematician in the world, John von Neumann, axiomatized that in 1947, the head of the Institute for Advanced Studies in Princeton. People are rational. Given what they believe, they pick a portfolio or they pick a trade that they think will maximize their risk-adjusted expected return. The problem is the morning after they said, damn it all, my beliefs were wrong. That's not a matter of irrationality. We don't call Aristotle irrational for not knowing that the sun didn't go around the world, the earth, or Newton irrational for assuming it was the other. It's called learning over time. We're learning, and some things you're never going to learn. We need a little humility here. We don't need to be calling everybody who doesn't agree with me irrational. No, 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 no. There's plenty of freeway for you to have your views on global warming and me to have mine. Don't call me irrational. Your bet may be right and I'm wrong, but I am not irrational for having had a worse theory. I was just wrong. At Stanford, what we're doing is reconstructing economic volatility theory on the basis of understanding the combination of mistakes with excess leverage. The combination of being wrong and being very leveraged is, as we will see, toxic. Let's go. In the standard Chicago school behavioral, it's called efficient market theory. The fancy word is rational expectations equilibrium, stemming from the work of Lucas in the late 70s. That's all the textbook stuff that underlies quant theory and all the rest of it. CAP-M, Black-Scholes, it's all of this tradition. In it, the 3 blue circles cannot happen. Repeat, in this paradigm, the 3 circles do not exist. I have called this mistakes-free economics. The standard stuff that is taught is mathematically equivalent to there being no ability to make mistakes. None, and in no finance book under M will you find the word mistake. Now this is a very subtle notion, but let me give you a historical precedent. Galileo's law of the independence of mass and G, the force of gravity, one of the greatest discoveries in the history of science. He took a bell jar, he sucked the air of it out. In the vacuum, a feather fell at the same speed as a big lead ball, remember? No air, frictionless physics, was a first step to the more general model, which included the predecessor theory, as it must, to a physics where we do know how feathers fall up in a storm and lead balls go down. It's just more complicated. But the first step was very important. The efficient market theory was a very important first step. But just as you never use Galileo's law in predicting what happens in a windstorm, you should never have used the efficient market models because they amount to the same as Galileo. This time, it's not that we don't incorporate friction. This time, we rule out mistakes. Number 1 on the far right, there is no such thing as everybody being wrong about an important story. You don't know the future. There is white noise around what will happen. But everybody knows the correct probability of everything forever, including global warming and the rise of China. You never look back and say, my theory was wrong. For those of you who are technical, this can only happen when you have a stationary stochastic process generating the news and everything is appropriately identifiable. It's simply absurd. Life is nothing about being wrong about everything. My father was wrong at 70 years old in not knowing, and nor did anyone else, that inflation having gone from 2 to 8% would go to 8 to 15%, and then he lost 60% of his money because bond prices went way down, correct? As bond rates went from 8 to 15%, he lost half of his money and died in 81 at the worst time, yes? He was wrong. That's not allowed. We know the correct probability forever of the news. There is no surprise. It's like the weather in Vienna. You know the true probability of temperature and rain every month by crunching the data from the last 100 years. But with global warming, which is a structural change, then you don't know. History does not teach you the correct probabilities. You'll have your theory of global warming, which must be subjective, and you'll have yours. May the one of you who is less wrong celebrate, because the one of you who is less wrong, thank God, is more rich. So, number one, there's no such thing as being wrong about the news. Now we come to the real dynamite. And the news in the case of the current crisis in the world was the news about the subprime default rate. This is like a butterfly effect. What in the world does the rate of default of subprime in 9 states in America have to do with bankruptcy in Iceland and a 40% drop in the currency of Australia? That is the Hindenburg effect, which we must solve. The Chicago School says, once I know the news about the weather, the default rate on housing, then I know, and you know I know, and I know you know, which is very important game theoretically, the correct new price. Everybody has a schedule. And if I know the news, the exogenous news, I know the new price. And you know it, and you know. It's always correct. There's no overshoot, no bubble, no nothing. It's ruled out. Given the new news, the price in the market is correct. Many people think that the efficient market theory proves that securities are correctly priced. Wrong. It is assumed. And it is now a Stanford theorem that almost all of the time, modulo set measure zero, securities prices are wrong. Always. Because people don't know very much. This variable is maybe the most important variable since the discovery of derivatives by Arrow in 1953. Pricing model uncertainty alone, that I know you do not know the correct value of a mortgage back, even when God tells you in advance the default rate, is the reverse of everything I was taught at Harvard, Princeton, and Stanford, correct? Oh boy, is this going to be an important point. You are living soaked like tea bags in PMU, pricing model uncertainty. When Ben Bernanke stands up at the Waldorf Astoria Hotel in New York a year ago and says, we know the news, could someone please stand up and tell me what this crap is worth? You know you have witnessed the demise of an entire discipline, and Alan Greenspan recently occurred. It is the death of the modern theory of risk assessment and risk management. It is gone. And the reason it's gone is due to a very deep theorem in game theory, which was only proved 5 months ago. The more the pricing model uncertainty of an asset, the more the price will way overshoot what people call its fundamental value. Let me repeat. The more an asset has the property that when God tells me the news, I know I don't know the new price, and I know you don't, and you know I don't, then the result of that is a game whose Harsanyi-Nash-Bayes equilibrium point, that is whose solution, is for the blind to follow the blind, for there to be a big overshoot of dot-coms way up and a tremendous collapse, say, in mortgage backs down, shooting way beyond any sense of their fundamental value, and that is admitted by the people in the market. Now, in the case of oil, I do not agree with you that it was this kind of a bubble. I don't think you even need bubble theory to explain oil. I predicted 5 years ago that it would go up and way down based on a different argument, but we don't have time for that today. But there are occasions when the endogenous risk, due to everyone knowing that no one knows the true value, and it's an extremely long mathematical proof, makes it rational for you to jump on and you to jump on and you to jump on. And the more the pricing model uncertainty, the more the overshoot, which when it's downward overshoot in conjunction with a market-to-market set of accounting rules means bankruptcy. Does everybody see this? My father lost 50% of his money merely because the news was bad that drives prices, but the bonds that he owned behaved perfectly. My Harvard textbook says if the inflation rate goes up by 700 basis points, then the long bond yield goes up by 7%, correct? And it did from 8 to 15% in 1981. But had my father owned a mortgage back, having a lot of pricing model uncertainty, whereas a government bond has none, it is the only asset where if God tells you all the news, you do know the correct new price, and there are no bubbles. They go way up and down. That's not a bubble. There was no bubble in the bond market. You've never even heard of that because there is none, but they had the same volatility as oil has had in the 70s because the news about fundamentals was properly priced, but it was the news that was the source of risk. The inflation going from 2 to 15 to 8 to 12, that was the story. It is not the story with mortgage backs. If my dad had held a mortgage back, it would not have gone effectively from a 7 to a 15% yield. It would have gone from a 7 to a 40% yield, and he would have lost 89% of his money, correct? Without being leveraged. Now we're warming up. Had he been leveraged 30 to 1, he would have lost all of his money. Got it? From a little stupid amount of news. And all of this because the rational solution to the game being played is the more the PMU, the more people follow, the more the blind lead the blind. It does not get deeper. It overturns 40 years of conventional wisdom. The big overshoots are due to irrational behavior. This is true given the very limited concept of rationality in the Chicago School of 40 years ago, but using the single most important concept of rationality ever developed, that of a Nash-Bayes equilibrium point in a game of incomplete information, 3 Nobel Prizes in 1994, it turns out that what we thought was highly irrational was completely rational. No psychobabble is needed to explain the huge overshoot in mortgage backs, which, since you're forced to mark to a fake, wrong market price, bankrupts the institutions and the country. So far, being wrong about the default rate and wrong about housing prices, which are much worse than anybody thought, and these weird trisexual securities, and they are trisexual, not bisexual. No one knows their behavior in or out of bed. Nobody has any idea. My friend Larry Summers at Harvard says he does not understand a convexified, leverage-embedded, optionality-embedded synthetic. If Larry Summers cannot understand the pricing models, God help the rest of us. All right. These are weird. They're the other end of the spectrum from bloody government securities that my dog knows how their price responds to the news. This is the other end. We have not even mentioned leverage. The best work on leverage was done 15 years ago from MIT at Stanford for the BIS in Switzerland. And we all know banks are supposed to be leveraged 10 to 1, correct? That's not arbitrary. That is the social welfare optimizing leverage, provided you have a central bank for periods of distress. 10 to 1 is the BIS capital requirement, correct? Well, I think that Barclays, UBS, Citi, I think I'm now hearing 38 to 1 average leverage. Now we need a little mathematics. When you have this kind of a problem, 10 to 1 leverage would have brought my father down, correct? He wasn't leveraged, didn't know how to spell it. He was old school. But 30 to 1 leverage is not 3 times worse than 10 to 1. It's 187 times worse given some normal assumptions because the nonlinear effects of leverage are staggering, as I'm sure I don't need to point out. Let me repeat. Leverage far more than ever should have been allowed, but was allowed because of a very bad philosophy that what's good for Goldman is good for God, and Alan Greenspan, who signed on to some stupid notion that economics was about markets know best, went from Adam Smith to Kenneth Arrow. The whole point of economics as a branch of the moral tripos at Oxford was to know under what conditions markets are right and markets know best. Condition number one, rule of law. No Putins allowed. No Chavezes allowed. No thugs and torturers allowed. Correct? No contracts being ripped up on Monday with BP, on Tuesday with Shell, and on Wednesday with Exxon. No. Adam Smith was about when do markets work best. It is now a mathematical theorem that excess leverage is a social externality like pollution. Excess leverage is bad, and government needs to stop it immediately. That is not an opinion. It is an irrefragably true theorem. It is equivalent to the fact that in true capitalism, you are not allowed to maximize profits if, when you do so, you pour poison in the river and kill his children downstream. To Adam Smith, that was a no-no. And excess leverage is exactly the same. John Meriwether, I don't care what you do in bed. This is Adam Smith playing tennis with John Meriwether Saturday morning in Greenwich, Connecticut, where you're now divorced by your wife if your income falls below $50 million a year. I don't care what you do. I don't care what you do in or out of bed. I don't care what you do with your money. But if in doing what you do with your money and leveraging 500 to 1, you bring my family down, I do care. It's exactly the same as pollution. But Greenspan, who has a third-rate PhD from a nothing school that he got at age 62, never learned how to think very well about these things, if you bother to check the record. He crunched the data. Did I forget hedging? I'm not even going to talk about hedging. The Chicago School says every risk can be laid off and hedged optimally. And when I have a hedge, it will never melt down. Really? Well, look at 1:31 on the afternoon of Black Monday. My Harvard classmate Haynes Leland had gotten very rich developing the theory of dynamic hedging. Remember Rubinstein, Leland? Well, you don't hear about them anymore. Every hedge melted down like butter on a skillet because the non-stationarity of the process caused the covariance matrix to go negative definite, and everything went to hell. Ooh, well, we won't talk about that. Please understand what you're looking at. Simply being wrong about the news, not knowing how to price trisexual securities, having hedges that have melted down, and being leveraged too much mathematically implies that extremely rational people will bring about everything that you have seen. It is not psychological. More importantly, when it comes to reforming the future, you're never going to get rid of the blue. Complaining about people being greedy is stupid. We're no more greedy or horny than we used to be. Read Aristophanes. Nothing's changed, so stop complaining about greedy people. There's no such thing as knowing how to price the Putin PE ratio. No one has a clue what the right PE is. It's not that you're irrational. It's too complicated. We're never going to know how to price new technologies. Schiller used to have a debate with, what's his name, Siegel at Wharton. One believed the right PE of Cisco in 1999 was 20, the other 300. Good, each had their own reason. I'm not going to call them irrational. But Schiller ended up right. But he couldn't prove in 1999 that the other one was wrong. We must be very careful before we call people stupid because of their beliefs. Very careful about that. You're not going to change the fact that you cannot hedge against being fired by an unfair boss. You cannot hedge the fact of your income if there's a recession. Tried to do that, anybody? The hedges are not available. I tried the ultimate hedge. I called Goldman 7 times to get a hedge against being proven impotent on my wedding night. Nobody would insure me. Right. This is known as the footnote missing markets problem. It undermines all quant theories if you properly understand it. Right. So theorem number 1, when you take the blue things, which you cannot change, and you add on the excess leverage, which is the only thing you can change, you can send people to jail who leverage more than 10 to 1. And have them tortured publicly every Tuesday noon and put on television, and I assure you there will be a lot less Gordon Geckos. Oh yes, it's not very funny when 71 million people will lose their jobs, so a few people could make 80 million a year not to get divorced by their bimbo wives at the Round Hill Club in Greenwich. Yes. This is what went wrong. We must realize that the solution is to rein in leverage. It's ruined everything. None of these problems would have turned into a recession for the world had it not been for leverage of 30 to 1. 10 to 1, it would have been easily manageable. Leverage with endogenous risk is responsible for the fact that AIG was a 15 billion rescue on Monday and 85 billion on Thursday. It's hard for normal people's minds to understand, Your Majesty, the scope and amazing speed of these crazy Hindenburg effects. Well, that's the butterfly effect, and you're living it right now. Now there's a final loose end. If you were to say, what has my analysis missed? The crux of it, which when I published this graph I did not understand, was how all of this would create a prisoner's dilemma game in the interbank lending game. Now this is really interesting. If you want to know how Wall Street brought down Main Street this time, you've got to go to the time when banks stopped lending suddenly to other banks. This has not happened before. When you understand that there are only 20 banks in the world that matter, that when you go to Australia and think that you are dealing with Commonwealth Bank, you are not. They're basically funded by Barclays and Allianz. No, there are 20 that matter. And if they stop interbank lending in 4 major cities in the world, you aren't going to get a loan a month later in Chile or Australia or Iceland. Never before has the interbank lending game stopped. Let me now show why it was rational that it would. This will draw upon the analysis so far. This is something I'm in the middle of writing right now for Summers, so my mind is not very clear, but it's being worked out. The traditional interbank lending game consisted of the fact that we guys who have big banks need each other. You see, the way it works in banking is you have too much money on Monday. Literally, this goes day by day. So I lend to you to make a little bit of return on Monday and Tuesday and Wednesday. But I know I may have to borrow from you on Thursday, correct? So we're all in and out of bed with each other, borrowing, lending. It has to be. Because God forbid, on Thursday, there's no one to lend to me. I know it, you know that I know it, I know that you know it, we're all in it. The equilibrium point of the game is lend, lend. Everybody's willing to lend. Now, that does not mean that, well, Woody, what about if his bank loses money? Listen carefully. Your bank has bet on 100 ships. 20 of them go down in a storm. That's been true of banking since the Phoenicians 3,900 years ago, yes? But I know you lost 20 ships. I know you've written down your net worth of your bank by 20%. This bank is 4/5 as big as it used to be. I go on lending to you tomorrow. I know exactly your balance sheet, and it's smaller. Yours is bigger because you made money. I'll lend more to you, but less to you. And you know that, and I know that, and there is no problem. The interbank lending game goes on. But remember, in game theory, the matrix of payoffs that you see in the textbook are not expected dollar losses. They're expected utilities. The utility of a dollar loss is the value to you of that loss adjusting for your risk averseness. So what did you think happens if rather than the banks of 1600 financing ships where we knew if a fifth went down or not, where instead of that, our portfolios consist of $1.9 trillion of trisexual securities, where no one has a clue how to react to the news about the default rate. This comes into play along with the leverage, and guess what happens? The risk of me lending to you explodes. The payoff from lending to you, measured in risk-adjusted utility terms, collapses because the risk is so huge. My God, look at what I've seen happen to Citi, to AIG, to all these people. I can't believe in anything anymore. And you know this, and you know that this is true for me. So the payoff matrix of the interbank lending game is radically changed. So that the new solution to the game is what? Don't lend, don't lend. It used to be lend, lend. So now it's rational for me not to lend, even though that will hurt me when I need you to lend to me on Thursday, correct? But the payoff matrix changed, and the new Nash solution is don't lend, don't lend. That happened 3 months ago. No irrationality was involved. It's tragic. But it never, ever, ever should have been allowed to happen. If you hadn't had the leverage, it never would have happened. That cessation of lending by the major banks is what brought down the main streets of the planet Earth. So when you ask why you can't get a loan in New Zealand or Australia or Iceland, the reason is the bank stopped lending. And the reason the bank stopped lending is that this diagram is why the payoff from continuing to lend became so bad that it became irrational to go on doing what you had done for 2,000 years, and you stopped. And that's it. What I've tried to do is to give you a perspective on where this crisis came from. Your Majesty, the Queen, you asked why no one saw this coming. The answer is both that the sort of the phenomena that constitute the crisis has never happened before, not like this. There have been crises galore, but remember, history never repeats. It rhymes. And boy, is this a different rhyme. And the reason why all this happened has to do with the complex interplay of bad regulation, letting people leverage up to limits that they themselves agree were crazy, weird new securities that we pretended using bad mathematical economics to be able to understand, when in fact nobody understood them at all. These are the complex securities that are mispriced. It's a whole story. But blaming greed isn't very smart, because you're not going to change greed. The main lesson here is, in a world like this with intrinsic uncertainty, like Heisenberg uncertainty, where you're never going to know the things you'd like to know, where no quant is ever going to tell you what you'd like to really know, because it's non-knowable, then suck it up, have some humility, know that life is always going to be very risky, and you're never going to know the timing of those fat tails. And this being true, never for one day, ever, ever, ever be leveraged 20, 30, 40 to 1. But you are not hearing this from Washington, are you? No. Ex-Goldman Sachs bankers run the Vatican, the Bank of Canada, and the U.S. Treasury, if you haven't noticed. All their money was made by very high leverage. None of them is able to make a better mousetrap, God forbid. It's only a leverage game. They're smart. They won. They've kept their 500 million each, and I know many of them. And now 70 million people will be thrown out of work. It's not funny. And government was asleep at the wheel. So that brings me to the end. Thank you very much.
Please, yeah. Are there? Woody has roughly 20 minutes. If you have any questions.
Disagreements, questions, and oil, certainly. The whole set of topics.
We're going to need, yeah.
I was just saying questions, disagreements, anything about oil first, and some of my remarks second.
In the back.
Solution to what? I'm sorry, you're saying what is the solution to the mess we're in today? I mean, that's a different talk, but very, very, very simply in one sentence. We all know the actress Madonna, correct? You know how many times she's changed, correct? Well, for a hint of what is to come, take a look in the last 12 months at the composition and size of the balance sheet of the U.S. Federal Reserve. It has reinvented itself far more than Madonna ever thought to. a very creative, interesting, and new use of fiscal and monetary policy, with deficits double and triple the size of anything that we have seen, and strategies by the Fed unlike anything we have seen, and they are already in place, is what we need, and it is what you're going to get. And the good news is we now have a president that people like and listen to, and he has a brilliant economic team, and the rest of the world needs help, and we're all in this together. And I think that whereas we are used to a lack of leadership from Washington, there's now going to be a lot more leadership and cooperation. So I think it's wonderful that we have Obama and the new team. But the fact of the matter is, this whole mess has been brewing for 30 years. One day we will look back on this and see it was inevitable. And all you can say is we need a leader who restores people's hope and confidence, and not just in America. And everywhere you need a very powerful dosage of fiscal and monetary policy of just the kind that we're getting. It doesn't guarantee that things are wonderful. It just means things will be okay and we will get out of it. The problem is we will get out of it, but we will leave the children of the earth another 10 trillion in debt. That's the moral problem. So you better spend the money on productive infrastructure and other things that permit tomorrow's people to pay the debt off more easily. Repeat, the moral imperative is we're going to run up a huge new debt. We've got to make sure we don't make it too hard for the next generations to pay it off. And that is a huge challenge, not only in my country, but I think in many countries.
Thank you. Any more questions for Stephen or Woody?
Oil prices.
He asked about if this will lead to inflation.
The inflation story, as you know, is extremely difficult. Here is the supposedly correct answer to the question. If you have a large new government deficit, and if the Treasury sells new IOUs, which it's been doing at auction, and raises 1 or 2 trillion by selling bonds and bills to the public, to the Smiths, to the Jones, to the Brocks, to the Abu Dhabians, those people who buy our debt write a check to the U.S. Treasury to pay for their new securities, but they write a check out of bank accounts whose money already exists. There is no money creation at all in financing large government deficits. There is no inflation associated with large government deficits in the case where a country does not have excess demand, which certainly we do not have. In the case of the Vietnam War, you did have that problem. If you do a regression analysis, you'll find no correlation between changes in government deficits and changes in inflation. This is a misconception. Repeat, financing big deficits by the U.S. Treasury is non-inflationary. The problem is, if the deficits are too big, you cannot get private sector to come up with the amount of money needed to write you a check without interest rates being driven much too high that kills the recovery. Repeat, if your financing needs are too big, then what happens is the public, they will always come up with the money because it has to be come up with, but the rates could get driven way up because you have to save an awful lot more now, and your investment has to go down because it has to equal the change in savings and investment. I think you get the point. So if the deficit is too big, interest rates can get driven way up, that is long-term rates, because the Fed will keep the short-term rate at 0. But those long-term rates going way up will kill the recovery. Because of this, we have a trick, a rabbit up our sleeve. 3 miles from the Treasury in Washington is another building called the Federal Reserve. The Federal Reserve Board keeps a bird in a cage, a bird inside a cage. If and when it wants, and nobody can tell the Fed what to do, the Fed opens the door to the bird cage, and the bird flies 3 miles to the Treasury auction, which of course is happening in New York City. And it comes down and it takes 300 billion of new paper off the table, and it carries it back home to the vaults of the Federal Reserve Board. The Fed now owns 300 billion of government securities, yes? And it paid for them by writing a check on heaven. It's called high-powered money creation. That is known as monetization of the deficit. That can lead to a Zimbabwe with 1 million% inflation. But you'll notice it usually does not. So if the philosopher King were deciding this, then the answer is the following. If the Fed monetizes the deficit to a certain extent, that means the Fed buys some of these bonds, not you and me. If it does this, in a period of deflation, whereas our 2% inflation this year is probably going to go down to 0 or -2 in a world of excess supply of everything, then it is good that they monetize the deficit, and it is good because they keep inflation at 2%, not -2. A democracy cannot have negative inflation because when your wages go down, but the amount of debt that you owe does not go down, the entire system collapses like a house of cards. The challenge then is, it's good to monetize the debt and have inflation until the sunshine comes out afterwards. But when the sunshine comes out afterwards, what you're supposed to do is send the bird out again. But this time the bird takes all those securities and it sells them back to the public, pulling back in that money that it created 2 years before. That is known as the sterilization of the monetization. And that's the way it should work, but in democracies probably won't.
Thank you. I'm going to ask you afterwards if you understood it, Gerd. Yeah. Are there any more questions? No.
Woody, can you give us some idea of the dollar's role as a reserve currency, how the structure will shift over time?
Is the dollar finished? Is the U.S. finished? It's all the same question. You hear it all the time. And, of course, as the U.S. declines and China rises and Europe rises, inevitably the dollar becomes less important. It has become less important. The share of euros in the reserve accounts has risen a great deal. I think the euro's been quite a success. The mistake that people make when they think this is they fail to do what you should do when you're dealing with central banks, which is to look to the very long run. The big story in the United States is not the story you've been hearing at all. And oddly enough, this is an example of where you can know the long run much better than you can know the short run. In the next 50 years, the United States will get much richer and bigger than Russia, Europe, or Japan. And the reason is its workforce growth and its productivity growth will be higher than in all other cases. We will have a 3% GDP growth. 3. Japan minus 0.4 with a shrinking workforce. Europe 1. If you exponentiate those numbers over 50 years, and then you remember that the growth of GDP is the growth of wealth, the fundamental theorem of macroeconomics. Repeat, the growth of GDP is the growth of wealth. Don't even think that that is not true. Wealth meaning the net worth of the society, and the power is wealth. What you're going to find is the United States is not finished at all. It will have another big resurgence. But China, in the very long run, I don't think until very late in the century, because China's going to have a lot of problems, will certainly be the biggest economy, but it won't be the China we know today. But they ought to be the biggest economy. They will be. I just think it'll take time. So the long-run dollar is fine. Its role as a reserve currency is fine. But in the short run, obviously, it's having problems. I would like, if it's all right, to just say something about oil, because I think it's only right. I was joking at my beginning of my talk. I hope you all heard that when I discussed endogenous risk, the whole point is that prices go up and down, like mortgage backs, much, much further than fundamentals can justify. I also pointed out, however, that there were other cases when you did not need speculation to explain huge price changes, that fundamentals would do the job. I also said you had to think correctly about fundamentals. Now, I started writing about oil 4 or 5 years ago. I ran the Stanford University Energy Forum ages ago when I was young. But the fact of the matter is, I was very worried that a structural change was occurring that would make oil prices go extremely high, and if we had a world recession, extremely low. I can put this in a simple graph, and this is something that adds on to what you're saying, and it's not contradictory to it, it just adds on to it. This is the kind of thing that can cause, this is the kind of development that can cause the trend you're talking about to germinate and then to go far. I don't have a flip chart because they don't use them anymore, but I hope you can see this is a graph. Price, quantity, supply curve, demand curve. Can everybody sort of see price, quantity, supply, demand? The point of the graph, and it's very striking, is if you should have, which is very rare, both the supply curve and the demand curve become vertical. Vertical. Meaning price has very little impact on what we consume or produce, then the more vertical they are, the exponentially larger, the hugely larger a fundamental shift in the position of either curve will have. So if you look at demand, and we've known about Chinese demand for 15 years, it's the one study the CIA did that was brilliantly accurate. The demand curve for oil moves way out because of Asia, and it did, yes? But if supply is stuck at 86 million barrels, and if demand is price inelastic, the price goes from 50 to 150 like a bat with no problem. And if you then have a world recession, the same logic in reverse predicts it'll go right back down to 40 or 50. And I have no idea the exact amounts, but this is very, very natural. Now, this is the spot price. Paul Samuelson in his famous paper said, speculation's impact is primarily on the shape of the forward curve, not on the spot price. There's a big argument about that, but the people I know think that that's generally correct. Without any doubt, people take big speculative bets on commodities, and you see contango backwardization, they come and go like a snake moving around, and I think that the movement in that curve is strictly due to speculation. But at a very simple fundamental level, no matter what the commodity, and copper is an extremely good example where I also used it to work, inelastic supply and demand pushed copper from $1 to $4 or whatever it was, and now it's right back to 160. I don't know the numbers these days. And the reasons there are well admitted to be there literally wasn't any, but the demand exploded and it was price inelastic. So you have to look at fundamentals the correct way using supply and demand curves which take into account the slope. The slope is what's important. It's very rare to get two vertical lines. When you do, it becomes very, very simple. And I use this, as I said, to forecast both up and down. And incidentally, the new news from Paris 3 weeks ago from the IEA, which goes even much further than Matt Simmons, is that the existing oil fields in the world are declining rapidly. That is, Russia, certainly Mexico is down 30% over whatever it is in a number of years. Norway, Scotland, other places. This is the correct meaning of peak oil. Not that we're running out of oil. You never run out of anything, ever. But the existing oil fields do run out, and always did, from Titusville, Pennsylvania, 100 years ago, which was the first great oil field to go dry. And the new evidence, I think, is that Matt Simmons is absolutely correct. We are literally running out of the old oil, and the problem with the new oil is there's masses of it out there. There's no shortage at all, but capitalism isn't working. You now have Chavez, the Iranians, Putin, acting in a way that oil companies have been buying back shares, not investing in new oil. These numbers are striking. And the result of this whole thing is you aren't replacing the loss of the old oil with the new output. And now we have the new news that 80% of refinery projects have been canceled in the past 6 months. So I am very concerned that we're going to have a huge new bubble in oil, huge one, and sowing the seeds for it. And I think that agrees with what you're saying. So.
It gets to the point where in classic economics, high prices are the best cure for high prices. So all of the investment that we've seen now going into supply, it works the other way now. Low prices are the best cure for low prices now. So all of the investment, the ability that allowed ConocoPhillips to theoretically thumb its nose at Chavez and pull out of the Orinoco Belt and reinvest in Shell into Canadian tar sands, all that is now going down by the wayside. I mean, we look at the rig counts in Canada right now, And at this point, from a seasonality standpoint, there should be an upward bias in the amount of rigs that are being deployed in Western Canada. That's decoupled now over the past month. So all the talk that we've seen now of Canadian tar sands, of the repopulation of offshore production in the Canadian Maritimes, is all going to the wayside now. So I'm absolutely bearish in the near term, but we are absolutely sowing the seeds for another potential run at $150 and $200.
Paris is even saying 300.
And it's absolutely.
They always denied it until now. Always.
And just it's interesting, and OPEC is always at odds with Paris. That they take a very different view, and they consistently are the mindset that Paris overstates the demand figures. So, and it's always contradictory to what against OPEC's interests at this point. But the seeds are, so if you are looking to invest, I mean, you know, the steel companies, you know, I'm a big believer in the Levi Strauss. You know, go for the Schlumbergers and the companies that are selling the infrastructure to go out and get to production, because we are, again, at a cusp where it's a great opportunity to start getting into this market, back into this market right now.
Okay. Thank you very much.